Hey there YouTube. So in this video I wanted to cover how do gift taxes work in the United States. There's a lot of misconceptions around gift taxes. A lot of people think that the donor is the person that does it. Maybe the recipient has to worry about it. So if you get gifted property from your friend or your aunt or your uncle, you've got to be responsible for taking the tax out and paying it to the IRS. A lot of bad advice out there. So what I'm going to try to do here is give some simple examples and cover the rules. I've got a slide here in front of us, and then I've got a Form 709, an actual gift tax return, another very simple one that we'll go through just to illustrate the main points here. So first point to remember is the donor of the gift is the one that's responsible for reporting the gift, if applicable, and paying any gift taxes, okay? It's not the recipient. So donor is the one that's gifting the property, and the donee is the person that's receiving it, okay? They're the one that's receiving the cash or the property, real estate, whatever it might be. So the recipient is generally not liable for having to do any reporting or pay any taxes. And when we get a look at the Form 709, you'll see why this is. There's a couple exceptions. One of the biggest one is gifts received by non-U.S. persons. So here in this example, if John is a U.S. citizen and he lives in Miami, and he gets a gift from his aunt who is a citizen and a tax resident of Germany, so she's not a U.S. person. If the aunt gives John some cash or property in excess of a certain value, because the aunt is not a U.S. person, the filing obligation and the taxes do rest with John. Okay, so that's one unique example where you might have some gift tax reporting for the donee. But 99% of the time, what I see is it's a U.S. person gifting property to another U.S. person. Now, the second big point to note here is the gift tax exclusion for on an annual basis. So the gift tax exclusion for this year, 2021, is $15,000 per donor per recipient. It was the same rate in 2020 as well. It kind of gets changed every few years. Mostly it's just adjusted for inflation. But what that means is that you as a U.S. person, you can give up to the exclusion to individual persons, as many as you want, without having to do any kind of gift tax reporting, so no Form 709 filing, and you're not having to be liable for any potential gift tax. So that's why a lot of families will do annual gifts of just up to or under this amount because they're trying to gift money away and reduce their estate but not have to worry about any reporting. So here we have an example. James is a U.S. citizen. He wants to give $14,000 each to his friends, Amy, Mark, and Brian. He's feeling really generous. So the aggregate amount of gifts that James made is $42,000, right? So it's the $14,000 times 3 people. But none of this is technically reportable because the $14,000 per person falls under that $15K amount. So in this fact pattern here, James wouldn't have to do a Form 709, and he wouldn't have to worry about any gift tax liability for that period. So now let's get an example where it changes up a bit. So if James gifted $17,000 to Amy during 2021, what would happen there? Well, now there's a reporting obligation, okay, and maybe even a tax one. And that's because James gifted over the annual exclusion to Amy during the tax period. Right, so he's only allowed up to 15, so now he's got to file a Form 709 because it's a reportable gift. Anything over 15K is reportable. Now, the $2,000 is deemed to be taxable on the return, so when we look at the return, you'll see taxable gift, but it doesn't really mean he's subject to taxes in the current period. And so the reason for that is each taxpayer is allowed a lifetime exemption, which you can use to credit against over your life to try to basically defer the taxes. If necessary, you even have to pay them on your death. So again, I want to re-emphasize here. If you give more than 15K to somebody during the year, it's taxable in the sense that you're going to have to report it, but it does not necessarily mean you're going to be cutting a check to the IRS for that year to pay taxes on the excess amount. So let's look at a Form 709 so we can get an example here in front of us. So this is a Form 709. It's being filled out for James, taxpayer, right? So he's the donor up here. Remember, the donor is James. The donee is the recipient. So you fill it out. The donor's first and last name, social security number, where do they reside. Answer questions 8 through 18 here as applicable. In John's case, this is the first one he's filing, so he's answering no to question 11A. And he's not doing any GST or anything like that. So this is a very straightforward gift tax return for the current period. So now we get down to some of the numbers on the return. So line 1 here, enter the amount from Schedule A. This is the amount of taxable gifts from Schedule A. So let's pause here for a second and skip over to Schedule A so we can see how that computation is made and how those numbers eventually flow back here. So if I jump down here to Schedule A, this is computation of taxable gifts for the year. So these are gifts only subject to the gift tax. Again, very straightforward. We're not doing any generation skipping taxes or anything like that. So here we have enter the name of the donee. So we have Amy, taxpayer. You can attach a schedule that provides the more detail here as requested, right? So the relationship to the donor, the description of the gift, in this case it's cash. So columns D through H here, the basis in the gift, in this case it's cash. So a taxpayer's basis in cash is generally always just whatever the cash amount is. It's a lot different than, let's say, property, where you have a cost basis and then some depreciation or something. In this case, his basis in cash is just the cash amount, right? So $17,000. He gifted the cash to Amy on, December 15th, 2020, right? So this is a 2020 tax return. The value of the gift on the date of the value at the date of gift, again, $17K. Split gifts, you can leave this blank unless you have spouses that are splitting gifts. Spouses are allowed to do that, but in this case, James is a single taxpayer. He's not married, so column G does not apply to him. And then column H is the net transfer amount. So this is the amount of the taxable gift that's going to be reported for the year. Now, if we scroll down further, we'll get to the gift tax reconciliation. This part is very, very important. So part 1, the total value of the gifts from the donor, right? That's $17K. That's coming from up above there. And then here's where we need to do a manual entry, right? The total annual exclusions for gifts. In this case, John made gifts to one person, right? So he gets $15,000 to basically kind of exempt from that 17 amount. So the net amount of taxable gift is $2K. The reason I want to highlight this is I see a lot of preparers actually miss to even put in number 2, right? So the number 2 field there, they'll leave out the $15K, and so then it creates this massive amount of taxable gift, or they'll get this number wrong, right? There might be gifts to a number of people, so let's say 7 or 8 gifts during the year, and they didn't do the appropriate math to get the $15K times 8 or whatever the gifts are. And I even see this done incorrectly in tax return prep software, where they don't even give you like a diagnostic or anything that says, hey, what about field 2, right? Do you want to put something in here? And so if I can just flip up here really quickly to make another point, this is the gross amount of the gift before the exclusion, right? So you're gifting $17K to Amy, but don't put $2,000. Don't put $17K minus 15. You want to put the gross amount of the gift, right? So in column F here, and then the reconciliation down here in part 4 is where you take the exclusion. So now that we have $2,000 of taxable gifts, we scroll back up to page 1, and this is where it makes a little more sense as to why the donor is the one filing this, right? So the donor, remember, if we looked at that back at the slide, individual taxpayers are allowed 11.58 million lifetime exemption, so they can basically incur gift tax up to those amounts without having to pay anything until their date of death, really. So this is the amount of tax that would be computed on that annual or that lifetime exemption, so 4.5 million. So when James computes his taxes here on line 4, $360, the $360 chips away at this 4.5 million. So unless you have gifts in the current year and the taxable gifts rolling forward from prior periods, unless you have gift tax that starts to exceed this amount, you're not actually going to go owe any tax for the current period. And so that's evidence down here, right? We have the balance due is 0, right? So again, James has to report this taxable gift. He has to compute the tax that's going to chip away at his credit here, but he's not actually writing a check with this return to pay any gift taxes. Okay, so this is an example of a first-year gift tax return. So if James had given taxable gifts in prior years, we would see amounts on lines 2 and 5, right, for the prior year gifts, and then line 8 would have the credit used in prior periods. So you would see a little more activity down here, but again, the messaging here is if the gift is over the $15,000, you got to report it, but it doesn't necessarily mean you're going to be paying tax on it in that period, right? You really need to file these returns every year to get a rolling number to compute what you might owe in the current period, right? So hopefully, that'll help clear up some of the confusion around gift taxes in this 709. Again, it's a very simple example, but I think it's helpful just to get a little basic understanding as to how these mechanics work for federal tax purposes. So thank you so much for watching. I hope it was helpful for you. If you have any questions, please leave me a comment below. Happy to help out where I can. And of course, I hope to see you again soon. Thank you.